Imagine setting out on a long hike, but you really want some expensive new gear for the trip today. So you make a trade. You load your backpack up with a few heavy rocks, and in exchange, you get a brand new tent. In the world of money, those heavy rocks represent debt. Look at this visual balance scale. It illustrates something called the leverage ratio. All we're doing is comparing the total weight of that rock-filled backpack against the physical strength of the hiker, which represents a person's or a company's income. When the trail is flat and easy, carrying those rocks makes sense. That extra gear lets you do more and travel further than you could on your own, and your body handles the weight without much trouble. But the trail doesn't stay flat forever. Think about what happens when the path suddenly gets incredibly steep. In the economy, this is like a sudden jump in interest rates. The terrain changes, and instantly that same bag becomes much harder to carry. Or consider another risk. What if our hiker twists an ankle? That's a sudden loss of income, like losing a job or a business facing a recession. In either scenario, the backpack is suddenly way too heavy for the hiker's current strength. You physically cannot take another step forward without collapsing under the weight. You have no choice but to shed the weight to survive the trail. This forced, difficult process of reducing your burden is called deleveraging. It's the painful result of your debt growing much faster than your ability to carry it. Once you're stuck on the trail, there are 4 distinct paths you can take to lighten that backpack. Let's look at the first option, paying down debt out of your regular income. Think of this as the slow grind. The hiker completely stops walking and devotes all their energy to pulling out rocks one by one. To do this, they have to stop buying any other supplies or food along the trail. If one person does this, it's a smart choice. But if every hiker on the trail suddenly stops spending money to empty their own backpacks, we hit a problem called the paradox of thrift. The businesses that rely on those hikers, like the local pizzeria in town, suddenly lose all their customers. That creates a ripple effect. The pizzeria owner has to fire workers. Those workers then can't pay their own debts or buy groceries, causing total spending across the economy to drop. We trigger a recession. That brings us to path 2, the fire sale. This is when the hiker is so desperate to remove weight that they sell their expensive hiking boots to a passerby for pennies, just to pay someone to take a few rocks away quickly. This drops the debt instantly, but selling your gear in a panicked falling market wipes out your wealth. You get rid of a few rocks, but now you're walking the trail barefoot. When millions of people all try to pay down debt or sell off their things at the exact same time, they inadvertently shrink the whole economy and make everyone's lives harder. The third path is much more abrupt. It's called defaulting. Our hiker simply takes the backpack off, drops it in the middle of the trail, and walks away from the debt entirely. But that dropped bag doesn't just disappear. The person who originally gave you the loan, the lender, gets crushed underneath the weight of the bag you abandoned. It ruins their financial security and their ability to help anyone else. This photo shows a foreclosure sign from the 2008 financial crisis. At that time, millions realized they couldn't carry their mortgage loans anymore and walked away, effectively dropping their heavy backpacks onto the banks all at once. When everyone drops their bags at the same time, the banks suffer massive losses and stop lending money. This photo of a crowded unemployment line shows the human cost of that collapse. It triggered massive layoffs and job losses worldwide. To avoid that kind of collapse, central banks sometimes try a 4th path, inflation. Imagine the central bank pumping a special anti-gravity gas into the air around our hiker. On paper, the rocks remain the exact same size, but because of the gas, they suddenly feel lighter. This reduces the real burden of the debt relative to your income, without the hiker actually paying a single rock off. Because walking away from debt can destroy the system, and paying it back can cause recessions, central banks step in aggressively to slow things down and manage the pain. To find the healthiest way home, we have to look at 2 different ways to handle the weight of that bag. The first way is the most obvious, literally taking rocks out of the bag. In the finance world, this is called nominal deleveraging. You pay the person you owe, the actual dollar amount of your debt goes down, and the counter on the bag ticks lower. But focusing only on the dollar amount is often too slow and painful. After the 2008 crisis, households spent years cutting back, but total debt barely budged. The backpack remained overwhelmingly heavy compared to the hiker's strength. So is there another way? How can you make a 50-pound bag feel lighter without taking a single rock out? You get stronger. Instead of focusing on the bag, our hiker hits the gym and builds muscle. We call this real deleveraging. As the hiker gets stronger, the untouched backpack suddenly looks much smaller by comparison. The math is simple. If your total debt stays exactly the same, but your paycheck doubles, your debt-to-income ratio is cut in half. Your income growth has effectively lightened the load. Deleveraging is like a fever breaking. It is unpleasant and can slow the economy down, but growing our way out of it is the best way to return to a healthy, sustainable hike. To see what happens when this goes wrong, join us next for Deflationary